A significant change is coming for some Americans who rely on Social Security. This is not a general cut to the program that affects everyone. Instead, it's a very specific policy that targets a particular group of people. Starting this month, June 2025, the government will begin reducing the Social Security checks of individuals who have defaulted on their federal student loans. This is happening because the Trump administration has decided to restart a program called the Treasury Offset Program, or TOP, for this type of debt. This program allows the government to collect on overdue debts by taking money from federal payments, including Social Security benefits. It's very important to understand that this change is not a broad reduction in benefits for all retirees or disabled individuals. Most people who receive Social Security will not see any change in their monthly payments. The policy only applies if you have a federal student loan and you have fallen so far behind on your payments that your loan is now in default. The goal of the government is to collect the money that is owed on these loans. This action was paused for several years, but now it's being enforced again, which means many people will soon feel its impact directly in their wallets. The timing of this change has caught many people by surprise. Notices started going out in May 2025, alerting the first wave of borrowers about the impending reductions to their benefits. The government plans to notify millions more people over the next few months. This is happening now because the administration is looking for ways to collect on outstanding federal debts. For many older Americans and those with disabilities who depend on their Social Security income to cover basic living expenses like housing, food, and medicine, this development is a source of major concern and financial stress. This move has reignited a debate about the growing crisis of student loan debt among older Americans. Many people took out loans for their own education years ago, or co-signed loans for their children or grandchildren, never expecting to carry that debt into their retirement years. The reality is that a growing number of seniors are struggling with student loans. The decision to garnish Social Security, which for many is their only source of income, highlights the difficult financial situations that millions of families are facing across the country. It's a reminder of how long-term debt can affect financial security late in life. So, how does this process actually work? If you have a defaulted federal student loan, the government can reduce your monthly Social Security check by up to 15%. For example, if you normally receive a benefit of $1,500 each month, the government could take as much as $225, leaving you with only $1,275. This is a significant amount of money, especially for someone living on a fixed income. The 15% figure is the maximum amount that can be taken. The exact amount will depend on how much you owe on your defaulted student loan. However, there is a legal protection in place to prevent people from being left with too little money to live on. Federal law states that your monthly Social Security payment cannot be reduced below $750. This is an important safety net. If your usual benefit is $850, a 15% cut would be $127.50, which would lower your payment to $722.50. Because this is below the $750 threshold, the government can only reduce your payment down to $750. This means they would only take $100, not the full $127.50. This rule ensures that everyone affected will still receive at least a minimum amount of their benefit. This program, the Treasury Offset Program, is not new. It has been used for years to collect various types of federal and state debts, such as overdue taxes or child support. What is new is the renewed focus on using it to collect defaulted student loan debt from Social Security recipients after a long pause. The process is automatic once you have been identified as having a defaulted loan. The Department of the Treasury communicates with the Social Security Administration to make the reduction before your check is ever sent to you. You will not have to do anything for the reduction to happen. It will be done for you. It's also crucial to remember this applies to different types of Social Security benefits. This isn't just for retirees. It also affects people who receive Social Security Disability Insurance, or SSDI. Many people who are unable to work due to a disability rely completely on their SSDI payments to survive. For them, a 15% reduction can be devastating, making it even harder to afford necessities like rent, utilities, and healthcare. The impact is broad and strikes at some of the most financially vulnerable populations who depend on these federal programs for their day-to-day survival and well-being. Identifying the affected population, the group of people impacted by this policy is quite specific, yet the numbers are very large. The primary targets are Social Security beneficiaries of any age who have defaulted on a federal student loan. This includes both older adults receiving retirement benefits and individuals of any age receiving disability benefits. The initial round of notices went out to 195,000 borrowers. However, government estimates suggest that a total of 5.3 million people could ultimately receive these notices by the end of the summer, signaling a widespread effort to collect on these old debts from a huge number of people. There is particular concern for older Americans. Many people assume that student loan debt is only a problem for young people, but that is simply not true. According to a report from the Consumer Financial Protection Bureau earlier this year, there are approximately 2.9 million Americans over the age of 62 who still hold federal student loan debt. The report estimated that around 452,000 of these older borrowers are at immediate risk of having their Social Security benefits garnished because their loans are in default. These are grandparents and great-grandparents who are now facing a major financial shock in their retirement years. The reasons why so many older adults have student debt are varied. Some are still paying off loans from their own education decades ago. Others took on debt later in life to retrain for a new career. A very large number of them co-signed private loans or took out federal Parent Plus loans to help their children or grandchildren pay for college. They did this to help their family members get ahead, but now they are the ones left with the financial burden. When these loans go into default, it is the older cosigner or parent borrower whose retirement income is now on the line. It's absolutely essential to distinguish this targeted action from any other discussions about the future of Social Security. You may have heard politicians talk about making cuts to entitlement programs to save money. However, those discussions are separate from what is happening right now. This specific policy of garnishing benefits for student loan defaults is not a general cut to the Social Security program. Your benefits are not at risk if you do not have a defaulted federal student loan. This is a debt collection tool, not a change to the fundamental structure or solvency of Social Security for the general public. If you receive a letter in the mail saying your Social Security benefits will be reduced, the most important thing is not to panic and not to ignore it. The notice you receive is not just a warning, it's an opportunity to act. It should provide you with information about the debt and explain your rights. Read the entire document very carefully. It will tell you which agency is collecting the debt and will provide details on how you can respond. You typically have a limited amount of time, often around 60 days, to challenge the offset or make other arrangements. So acting quickly is very important. Your first step should be to contact the agency listed on the notice. This is usually the Department of Education's default resolution group or a private collection agency working for them. You can ask them to verify the debt to make sure it is actually yours and that the amount is correct. You also have the right to request a review of the debt if you believe there is an error. For example, you might have already paid it off, or you might be eligible for a loan discharge due to disability, or you might be the victim of identity theft. You must present your case and provide any proof you have. If the debt is valid, you still have options to stop the garnishment. You can try to negotiate a settlement or a repayment plan. Getting your loan out of default is the best way to protect your Social Security benefits. There are programs available such as loan rehabilitation or consolidation that can help you do this. Loan rehabilitation typically requires you to make a series of 9 affordable monthly payments over 10 months. Once you complete the program, your loan is no longer in default, and the threat of garnishment will be removed. This can be a pathway back to good financial standing. If you feel overwhelmed and are not sure what to do, seek help from a trusted source. You can contact a nonprofit credit counseling agency for free or low-cost advice on how to manage your debt. The National Consumer Law Center is another excellent resource that provides information about student loan rights. You can also reach out to your local legal aid society to see if you qualify for free legal assistance. Facing a reduction in your primary income is scary, but there are resources and professionals available to guide you through the process and help you find the best possible solution for your situation.